welcome to Purple Trading. This is Kiriago from the Purple Trading Office, and I'll be taking you through this tutorial on the importance of money management and risk reward. So welcome to this video on money management and risk reward, and primarily we're going to look at the importance and benefits of applying risk reward to your trading, to your account, and ultimately this will help in maintaining a healthy balance for us to be alive in the market and therefore to take advantage of the potential opportunities. So the topics we're going to look at, I'm just going to go over the introduction, some things that I've seen and how we can improve on from my own personal experience and handling traders and mistakes in the past. Risk reward, and we're going to look at percentage exposure relative to your account, the optimum position size you should consider when determining your exposure, and the importance of the average daily range to gauge the potential of making a winning trade with a take profit, and at the end how this all ties in with the money management concept. So this is a classic scenario that I've seen in the past. It's also happened to me as a trader, and it's something we call winning in spoons and losing in buckets, and ultimately it comes from not determining your risk and not determining your reward before you open a position. So without any stop loss in place or take profit even, people tend to, or when they get into a winning trade, they tend to close their positions too early and let their losing trades run for too long. So ultimately, even if you choose the direction more times than not of an asset or the price, it doesn't necessarily mean that you will grow the account. So money management is fundamental in the overall success of your trading. So what is the beauty of Forex trading? And I feel that this is something that a lot of traders do not take into consideration, and it's maybe because they're not aware or take this aspect of trading seriously. So we can say that irrespective of the method and even determining the direction of an asset, correct money management with risk reward can help grow your investment, whatever way you look at it. Now, you can apply money management to any time frame, any type of analysis you're using, whether it's fundamental, whether it's technical, because ultimately it can come down to, or will come down to, probability. So, before you open a trade, we have realistically we have a 50-50 chance of choosing the initial direction. Okay, but when I do choose the direction correctly, I want to make sure that I'm fully taking an advantage of my investment and the amount that I'm determined to risk. Okay, so it's very important we determine our initial risk, but also the potential reward. Like any business model or business idea, you ultimately go into business to make a profit. You buy something for $10, and if you're in the retail market or retail business, the minimum you're going to sell that item is $11. Okay, so to pay for your expenses and leave some profit behind. So we try to, or should apply this principle even to trading. Okay, Now, if we do this, we can actually compensate for a string of losses, even up to 70%, and still come out on top with a healthy balance and even a profit at the end, irrespective of the method. And also, it's very easy to apply. So, risk reward, for example, we can have a balance of 1,000, and um, we can be rewarded with $100. So we have a starting balance of 1,000, and this is an example of what not to do, by the way. So $1,000, we buy one lot, which is $10. There's no stop loss in place. So in theory, we're risking $1,000, even though we've made a profit of $100, if we've been fortunate enough to choose the direction of the trade. So the potential risk is 1,000 to make 100. This doesn't make good business sense. Okay? And it's what I consider a low value trade. So in effect, the risk reward policy here is 10 against to make 1 for. So the correct application of risk reward, and ultimately you decide what type of trader you are when applying this. And they can be categorized into 3 types. So the less aggressive traders will go for a risk reward policy of 1 to 2. Moderately aggressive will look for 1 to 3, and the more aggressive traders even 1 to 4 or even 1 to 5. So let's consider the first two. In my opinion, it's a more realistic picture. The currency market is not that it can be a slow moving market. So a risk reward policy of 1 to 2, in my opinion, is very feasible. So if we consider the first two, we have $100 risk to make $200, or 10 pips, we're risking to make 20 pips. And then the more aggressive traders, or the moderately aggressive traders, will be to risk $100 to make $300, or 10 pips to make 30 pips. So whenever we take a position, determine our stop loss, take profit, to make sure we're getting value from every trade. Okay, even if we end up in losing that trade. Okay, it's fundamentally important. So just to show how we do this, I'm just going to go back. I'm just going to go to a live chart. Okay, and currently looking at the dollar versus the Japanese yen on a 1 hour time frame, and this market is trending up. So again, you can apply money management to any time frame. Obviously, the bigger time frames tend to be more reliable when it comes to technical analysis. So yeah, I'm just going to draw some support and resistance lines just to give you an idea of where I would have considered taking this position, and also how I would apply a risk reward policy of 1 to 2 by opening one lot, which is $10 a pip. So I'm going to use a Fibonacci tool to draw my support and resistance lines. And what I like here is I can see on a daily chart, price is trending up. That's fine. I'm going to go down to the 1 hour time frame again, and I'm going to draw from the lowest low that I can see visibly to the highest high. Okay. And so price came down towards this support level. We've got an indecision candle, and I also got a color change using our indicator here, signifying a potential reversal. So I've got two levels of confirmation: support line, a color change. Feel free to visit the website and download the Purple Strike indicator. It's completely free. And so I decided to open a position and buy the dollar against the yen using a risk reward policy of 20 to 40. So 20 pips to make 40 pips. So I'm just going to go ahead and open this. So I'm in a buy position. And now I would like to apply my stops and take profit. So in your navigator window, you can see the trade that's been opened. So if you don't have this up, just switch to trade. Again, and from here, it gives you the option to put your stop loss. So we double click on stop loss, it'll bring up this window here, and it says current level is 200. Now, it might be something else for you. So I'm going to put 200. We're looking at a 20 pip stop loss, therefore. I'm going to copy as and then place this stop. So stop's in place, and I'm just going to hover over here, and it's telling me that I'm risking 19 pips, close near enough, yeah, which equates to $173. So if I lose this trade, I'm down $173. However, might take profit. I want it to be double that, so 400 here, so 40 pips. Copy as, and then I've got my take profit in place. Can't see it on this chart, but if I go to a bigger time frame, it should come up. So on a daily, take profit in place, and again, it's telling me that I'm going to make 40 points, and that would equate to $377 if I stay in this trade. So going back, so we've seen the correct way to apply risk reward and how to open this on a live chart. And now we're going to look at position size and exposure. So this should obviously be relevant to the investment amount and or any running equity amount for multiple positions. So you don't have to maximize your exposure on one trade. You can open multiple positions as long as you don't go over or overexpose yourself. Now, a recommended amount would be not to exceed more than 5% of your balance at any given time. So if we consider the following, if we have a $400 initial balance and buy one lot, it's $10 again per pip or per point, with a 40 pip stop loss. We're definitely over exposing ourselves because 40 multiplied by $10 is 400, and if the trade goes against us, then all the funds will be depleted. So the exposure is too high. One lot exposure is too high for a $400 account. Okay, so to calculate the optimum exposure for a $400 account, okay, what we need to know, or how I work this out, is I want to know the monetary value of 5% of my $400 investment, because that's ultimately what I have to play with, yeah, when I'm opening a position. So I've just prepared a calculation on how we work this out. I'm going to close this window. And very simply, if I want to know what 5% of $400 is, it's 5 over 100 multiplied by $400, and that's $20 of my account. So I've got $20 to play with, and I want to know what position size I need to open that I'm actually, so to actually expose 5% and not overexpose myself and not go over 5%. So if many traders, they have a predetermined stop loss in mind. So let's say, for example, it's 40 points and I want to stick to that rule. Then it's $20 divided by 40 points gives me 0.5 cents or 50 cents. Okay. So what does this mean in lot size? So for me, not to go over 50 cents, then the maximum position I need to open is 0.05. Okay. So 0.01 lots is equal to 10 cents. Therefore, 0.05 lots is equal to 0.50 cents. Okay, so the lot size I should open, or the optimum lot size, will be 0.05 lots, so that I'm not overexposing myself and keeping my exposure to 5% if I want a stop loss of 40 points. Okay. So, yep. So by applying this principle, we can ultimately we are trying to maintain a healthy balance at any given time, and even if we have a string of losses, there's still enough in our account to recover. Okay. So consider risk-reward ratio of 1 to 3. Will only require 4 winning trades to make a profit. Okay, so if we had a string of losing trades with the above, using the above money management profile of 5%, and we had a risk-reward policy of 1 to 3, we only require 4 winning trades to make a net profit of $20. Okay. So what is this saying? If we keep our exposure to a sensible amount and applying risk-reward, so adding value, letting the trade run naturally, we can actually place or lose more trades than we place, and still potentially make a profit, irrespective of the method. So again, this is an example of position size. We have a example of a balance of $2,000, 5% risk, stop loss of $100, desired stop loss of 40 pips. Therefore, one standard lot pip value is $10. The size of the position is a quarter of that, so the pip value will be $2.50. So 0.25 lots on pound USD is the optimum size of the position. Stop loss is 40 points. Take profit always 80 pips. And the overall risk is $100 to make $200 and a risk reward ratio of 1 to 2. So again, this is an example, or the correct example of how to determine your exposure, your lot size and position size to sustain yourself in the market. Now, also what's really important, and an additional tool you can use possibly to gauge the potential of making a winning trade. And when I say winning trade, a trade that's gonna hit your take profit. There's something called the average daily range, and basically, again, it indicates the volatility or the current volatility and trading potential of an asset you are considering trading. Now, the way it's normally worked out, it's an average of 14 daily candles, so the price movement of 14 daily candles, whether it be euro dollar, pound yen, whatever it is, it's an average. They take an average of the price of the last 14 candles or daily candles of a particular asset. So I recommend to know the average daily range for the pairs you like to trade, and I've just included the link for where you can get this information from. And it's even if you Google it, something will come up regarding the average daily range, and it will point you to the direction of where you can find this information. Okay, so the way we can access the information regarding a pair that we want to trade and see its potential and its viability, simply just go to a live chart, and then we're going to choose the daily candle, obviously. We're going to zoom in. So I'm looking at USD yen, and let's say, for example, the average daily range for this pair is 100 points. So on average, over the last 14 days, this pair has moved 100 points. And I'm considering taking a trade. I want to know how much this pair has moved today or on this daily candle. And very simply, we take the crosshair, and then we just, so this is the highest price reached, this is the lowest price reached today, and we're just gonna click and drag to see how much this candle has moved. Okay, and already this candle has moved just over 48 pips. So if this candle on average moves 100 pips, it's already moved just over 40 pips, okay? And my risk reward policy is 40 points, or my take profit is 40 points, and my stop loss is 20 points. There is some potential in being able to reach my target. If the average daily range is 100, it's moved 42 points, then in theory I have another 38 pips to go. But if my take profit is 20 points, then there's a very good chance, if I choose the direction of the trade, that I'm gonna make that a winning trade. So this will really depend on what your stop losses and your take profit in terms of pip movement will be. Okay. So I'm just gonna show you this again, how you get this information. Let me just take away these tools. So again, I'm just going to go to the crosshair, and then there we go. Roughly 45 pips. That's moved. Okay. So this is a way again to assess the potential of the trade relative to your risk reward policy, and if it's viable enough. So the message is obviously allow enough room for this to be a viable trade when considering opening a position. So definitely this is a game of mindset. It requires discipline, but I think the discipline will come once you know and understand money management. So also by having the flexibility to determine your risk, but also your reward, should give you more peace of mind, and be more confident when you're trading. So this is something you should consider applying to all of your trades. And it just means that you'll be taking your investment more seriously when you get into this habit. So it's a good thing to do. And hopefully will lead to you being a more successful trader. Okay. And really, this is the story with most businesses. You know, good money management, discipline can only mean success. So thanks again for watching. I hope the tutorial has been useful and shown the importance and essence of money management and risk reward as a positive thing, and something that will increase your chances of being successful as a trader. So thank you again for your attention. For more information, please visit our website. We have a great support team there that will be able to assist with any questions and point you in the right direction. And best of luck with all. Thanks again.